It simply updates board meeting requirements for well-rated established credit unions. And it currently has 58 co-sponsors in the Senate and passed the House last year by voice vote. Do you think this is a good idea?
Tonight, we're breaking down a high-stakes Senate hearing focused on two powerful forces in the American economy: the Federal Reserve and the nation's banking system. Lawmakers are weighing praise for the Fed's handling of inflation against sharp criticism over allegations of debanking customers for reputational risk. At issue, monetary policy, political neutrality, and who ultimately gets access to the financial system. This isn't just about interest rates. It's about trust, oversight, and the boundaries of regulatory power.
The chairman and the vice chairman and others should raise or lower interest rates, and what we should do about quantitative easing and how many economists can dance on the head of the pin. The same thing about gun manufacturers and oil and gas and anybody you don't like, and you let the banks do it.
I was not the vice chair at the time
I know that.
Decisions were made.
But your institution went along with it. The banks proposed it, and your institution sucked it up like a Hoover Deluxe. Thank you, Mr. Chairman, for that courtesy. Madam Vice Chair. Credit should be given when it is due. I remember, 3 or 4 years ago, Chairman Powell and others were giving a report on the economy. Inflation was 9%. Was gutting the American people like a fish. Stevie Wonder could have seen it coming. President Biden asked, and Congress consented, I didn't, that we start spending money like it had the value of Louisiana ditch water. Had President Biden, had we discovered life on Mars when President Biden was president, he would have sent it money, immediately. And I remember the Federal Reserve, represented by Chairman Powell, sitting here, and we're talking about what to do about it. And he explained his plans, and in so many words, I said, not going to work. I've read the white papers. You can get inflation down, but we're going to have to suffer unemployment of 7, 8, 9%. It didn't happen, did it? We had a soft landing. And the Federal Reserve was in part responsible, in the best sense of the word, for that. And we don't applaud that enough. And we can debate whether the chairman and the vice chairman and others should raise or lower interest rates, and what we should do about quantitative easing and how many economists can dance on the head of the pin. But it's a fact. We had a soft landing. Thank God for it. Now, inflation is not down where we want, but 2.7% is a hell of a lot better than 9%, without having to suffer 7, 8, 9, 10% unemployment and the human misery that goes with it. So the Fed did something right. On the other hand,
up to this point, the exchange highlights a rare moment of bipartisan acknowledgement. Inflation peaked near 9% in 2002 and has since fallen significantly, with unemployment remaining historically low, a scenario many economists once thought unlikely. The so-called soft landing has been widely debated, and Fed Chair Jerome Powell has argued that measured rate hikes were designed to cool demand without triggering mass layoffs. But now the focus shifts. The concern over debanking raises a deeper constitutional and regulatory question. Should financial institutions consider reputational risk when deciding who to serve? And where's the line between risk management and political discrimination? If access to banking becomes politicized, in either direction, what does that mean for financial neutrality in a democratic system? And how should regulators balance safety with fairness?
What in God's name was the Fed and some of your other agencies thinking when you allowed banks to debank customers for reputational risk? Are you kidding me? Why did you allow that to happen? Because you didn't like their politics, or you didn't like the products they made. I mean, do you think it would be fair? Senator Warren's not here, so I hesitate to talk about it. Senator Warren was a distinguished professor at Harvard University. Some people don't like Harvard. Some people don't like their politics. How could you possibly allow a bank to have the option? I'm not saying they did it, but to debank someone like Senator Warren, I'm using her as a hypothetical example, because you didn't like her politics. And you can say the same thing about gun manufacturers and oil and gas and anybody you don't like, and you let the banks do it. What in God's name were y'all thinking, Madam Vice Chair?
Well, Senator, I appreciate your concerns and I share them. I was not the vice chair at the time
I know that.
decisions were made.
But your institution went along with it. The banks proposed it, and your institution sucked it up like a Hoover Deluxe.
In my view, debanking is never an appropriate activity. It is every American in this country should have access to financial services, and they should not be limited from access to those services based on their political, religious beliefs, or their engagement in a particular business that may be disfavored but is legally
Let me tell you, folks, this isn't over yet. Thank you, Mr. Chair.
Thank you, Chairman Scott and Ranking Member Warren, and to the witnesses as well. Chair Hauptman, I'm going to start with you before I turn it over to Vice Chair Bowman. I have a bipartisan bill with Senator Hagerty, the Credit Union Board Modernization Act. It simply updates board meeting requirements for well-rated, established credit unions. And it currently has 58 co-sponsors in the Senate and passed the House last year by voice vote. Do you think this is a good idea?
We're going to talk about what Congress says.
Your mic, I think the microphone is.
Oh, yeah. We're going to, obviously, Congress set that years ago that every 30 days they have to have a formal board meeting. And it's somewhat unique. Now, at NCUA, listen, we're going to do whatever Congress says. They do find it odd that Congress has NCUA enforce a rule that they have a formal meeting every 30 days to say that this entity cannot function unless they have a formal meeting every 30 days. And Congress tells NCUA to enforce that. You know who else doesn't have a formal meeting every 30 days? Congress or NCUA. So they find it a little odd. They say, oh, we have to meet every 30 days. Congress told us that. When did they say that? Was it during their 8-week recess? Is that when they told us? So they find it a little odd for well-meaning ones, and it's not something subject to others. But again, we're going to do what Congress says.
I know this is one of our credit union's top priorities. And so since they do a lot for our communities as well as our small businesses, I'm glad to see it has a lot of bipartisan support, and we hope to see it pass here in the Senate as well. Vice Chair Bowman, I want to turn to the Federal Reserve's exploration of the so-called skinny payment accounts. I support payment innovation, but access to the Federal Reserve's core infrastructure is not a small privilege. So I want to understand the risks before expanding access. The Fed's payment systems, also referred to as payment rails, including Fed ACH, FedWire, and FedNow, move trillions of dollars and underpin payroll and business transactions nationwide. Do you agree that if a bad actor were granted direct access to those systems, that could increase risks related to fraud, illicit finance, or operational disruption.
I think that's an accurate statement, yes.
And since those systems operate at scale and speed, problems can spread quickly when something goes wrong, correct?
Yes.
Today, most non-bank payment firms access those rails through regulated banks, which create checkpoints, including anti-money laundering controls and supervisory oversight. If a non-bank were granted direct access, that checkpoint would be removed. Would you agree that increases the importance of the firm's own risk controls?
Yes, it's very important that any firm that has access to the payment system has those controls in place.
This hearing ultimately captures two competing narratives. On one hand, lawmakers credit the Federal Reserve for guiding the economy from 9% inflation down to roughly 2.7% without the severe unemployment many predicted. On the other, they challenge regulators over whether banks, under supervisory watch, unfairly restricted access to financial services based on politics or industry type. The broader takeaway is about institutional responsibility. Central banks manage inflation and employment, but they also influence the guardrails of the financial system. When innovation like direct payment rail access or skinny accounts is considered, the stakes grow even higher, especially regarding fraud, oversight, and systemic risk. So what do you think? Was the Fed's approach a policy success? Or are there deeper accountability questions that still need answers? And when it comes to debanking, where should regulators draw the line? Share your thoughts in the comments below. If you value balanced, fact-based analysis without the noise, be sure to like this video, subscribe to the channel, and turn on notifications so you don't miss our next in-depth breakdown.